Hello, welcome to another episode of Daily Market Mastery with me on this Wednesday. I think we have Wednesday, yes, afternoon. I hope you all had a great start into the new week so far. As always, before we jump into the markets, let's get the usual disclaimer out of the way. Everything that I share in this live stream / video is my personal opinion and in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. That said, besides that, all the tools that I'm using, so the charting software, the broker, and the strategy I'm following and so on, are linked in the description down below. And the one thing I recommend, as always, if you haven't done so, go check out the Elliott Wave principle, which you can read online for free when you use the link in the description down below. That said, let's jump into it, and let's start by greeting Olga. Hi, great to have you here. Clash of Tunes. Faintly recall that username. It's been a while since I started the channel. It all started with GameStop, and there's been a long time of inactivity, but now there are daily streams again. Now, looking at the portfolio, although they are not as long as they used to be when I started the channel, so don't have the whole day to cover the entire market. Looking at the portfolio, we have a slightly red start into the day. The biggest positions, for those of you that have been following around for some time, are obviously our GameStop shares that we hold here, outside of the ones that I already hold at ComputerShare. And against the shares here, we're actually selling covered calls every week to earn premium. And then with that premium, we buy some extra shares or we buy some other positions and so on. And so let's take a look. Yes, what happened since yesterday? Oh, I forgot to start Motive Wave. 1 second. So can I have a sip of coffee while we're waiting for that to fire up? So there we go. Pretty much or almost as predicted. Let's zoom in a little bit. Not yet as predicted. So we are hovering around the 26.30 mark right now. Based on how we had it yesterday, which is based on this here, I would expect that we still get a push down to 23 in that area, 22.99, 23.23, because that would mark if we zoom out again for our chart, that would mark the 61.8% retracement level of this entire clearly visible 5-wave move, 1, 2, 3, 4, and potentially 5. However, we have to consider that we also would need 5 waves in this move here, and they are not that clear, which means we also have the possibility that we are right now only retracing this move here. I know it gets a little bit crowded on the chart now, but if we're only retracing this move here, we see that we already retraced actually 78.6%, in which case we would now be in the next or final move to make this 1, 2, 3, 4, and then wave 5. However, I don't like that idea very much, to be honest, because we retrace very far down here in this. So this move here already got very far down and entered the area that we would have here. So while it's not off the table, that we from here still get another push higher, which would then, if that were to happen, go towards, let's get a target area, go toward, come on, back there, and just move this. So would need to go probably, like here, 29.67. So potentially 1, 2, 3, 4, and then wave 5 in the area between 27.15, but should actually go above 28.79, so up to 29.67, plus minus a few cents. So that's one of the options on the table. If that were the case, then after we reach that area here, so close to $30, then we would get a retracement. Because again, if we look a little bit on the whole movement, from what it looks like on the 4-hour chart, we have a wave 1, wave 2, and then this is basically the third wave. And that third wave again subdivides into wave 1, 2, 3, 4, and 5. And while that fifth wave already has to be extended because it goes a little further than we usually expect, it's still visually, with the naked eye looking at this, it looks like we only have 1, 2, 3, 4 in that 5th wave down. So there is an argument can be made that we still are getting one more push. 2960 was the 100% target area, and then from there we would get actually our from there we would actually then get our retracement before we then go further up. Yeah, so I don't like that idea very much because we already got a little bit higher, and especially because we are right now, we can see if we look at here, if this is our wave 1 and 2, then our 3rd wave very often bounces on one of the following levels. So I'm just going to drag an extension here. Yeah, so and I'm going to drag that smaller. So very often when we have a wave 1, then wave 3 touches, in most cases, the 268.1 extension level. But in other, or in, if it's not that level, then very usual or very often one of the other 3, so X38.2 or X36.8 levels. Yeah, it's not always the case. We're never talking about certainties and guarantees here. We're talking about probabilities and how often certain things happen and so on. Yeah, but based on that, because when we look here at this wave 1, 2, we can see that we actually hit the 438.2 extension with this move and almost the 461.8. Which points towards this could indeed already be the final wave 3. So 1, 2, 3, in which case, again, we would right now be retracing this entire move, and then we would still be missing one push further down in this entire move, which then the next most common retracement level would be the 61.8% level, which also happens to overlap with the 100% expansion in that area. Hi, Rai, great to have you here. And yeah, so that's why personally I like to prefer the option that actually we are still about to get another push down into this area. However, as I point out, visually it looks like we're still missing a wave in this move here, and in that case we would expect 2960 for this move, which would then be here 1, 2, 3, 4, 5. So 2960, maybe a little higher, maybe we touch the 30, and then we would, however, retrace. So if we go to 2960, then we would start a retracement based on this, not this move, sorry. Based on, then we would start a retracement based on this move. So 2960, and would still expect to go down potentially, oh no, there is 61.8. I hit the other levels here already, but probably to 27 again or so. So yeah, and it's going to be interesting to watch which of the two cases happens. Or if I'm completely wrong, I mean, I'm not always right. Yeah. And depending on which case happens, it, however, doesn't change much, because the only difference is either we go to 2960 or maybe touch 30 and then get our retracement. That again brings us down. I'm actually going to put another retracement on the chart to show the exact levels. So if we go to 29, and I'm going to move a little bit further here. So if we were to go to 2960 roughly, then we can see that we would expect a retracement to 2566 or 2348. So those are the two most common retracement areas for corrective waves in my experience. And after that, we would still go further up, because then we only would have wave 1, 2, 3, 4, and then wave 5 would still be missing in that 4-hour chart impulsive pattern here. Yeah, if we use Kennedy channeling technique, we also can assume we have our base channel here. So we have basically starting point high for wave 1, down point for wave 2. Then we have our breakout here that indicates that we're now in the 3rd wave. And then from this point here up, so that's our so-called base channel, connecting point, the starting point with point 2 with a parallel through point 1. And then we take our point 1 and whatever high point we have. So for example, this high point here with a parallel through point 2. And if we have a breakout to the bottom here, then we have basically a confirmation in quotes that we are in the 4th wave. So the moment we have the breakout to the bottom of the so-called acceleration channel, we would have the confirmation the 3rd wave is over and we're in the 4th wave. We don't have a breakout here. However, when we look here, and again, parallel through point 2, we actually had a breakout here. So like a noticeable one. It didn't close outside of the candle, so one can argue about it. So there is also with Kennedy channeling technique, there is an argument that can be made that we actually are still likely going to see another push. Again, then 2960 would be the target area for this. And then basically that would shift that to here, 2960 somehow, again adjust that 2.2, blah, blah, blah. And then we would slowly get a retracement that basically should then give us the breakout here. So yeah, so even with Canadian channeling technique, we don't have 100% certainty if we indeed already finished wave 3 here and that was wave 4 or is wave 4 or not. Yeah, so overall still bullish. The only question is right now 2960 to maybe touching $30, maybe briefly going a little bit above it, but it should actually, the candle, the 4-hour candle should ideally close below 2960, even if the wick, so the line, goes through it. And then retracement, and then we go further up. So I think the only question is like, which way do we go first? So obviously it's tempting to say, based on the movement that we have right now, that we will go up further first. But yeah, that could also like be misleading. If we look a little closer, so I said we would need a free wave a free wave corrective pattern. So, and visually on the hourly chart, we only have wave 1, so wave A, and then maybe wave B finished, but maybe not even that. Could also be that this here turns into A, B, and C. Yeah, then we would go a little higher here before we get the third wave down, which would just require the predicted downwards area to be adjusted. But core point is, visually we don't have a free wave corrective pattern here finished, which points towards this corrective pattern not being, or which points towards that this corrective pattern is not complete yet. So yeah, so what does it mean? We're waiting. We still have, as said, the our covered calls against the 500 shares that are expiring next Friday. At a strike price from 30 to 35. The strike prices are picked because I got those shares assigned by selling $30 cash secured puts. So I got the shares at a strike price of 30, and if I have them called away, I want to have them called away as a profit. And outside of those 500 shares, we also have 26 extra shares that we already bought with the premium, plus another 100 shares that we also bought with the premium that are now sitting safely at computer share. Yeah, so but that's pretty much it about GameStop. It will be a little bit more of a waiting game here. It's frustrating, of course, in between when we zoom out a little bit, whenever we have like long drawn out sideways movement, although that sideways movement here is nothing in comparison to what happened earlier. Yeah, but I think, I don't know, like I have zero reason to believe that we will not go much higher. Yeah, we're unfortunately not at a point where I can make any kind of prediction as to how high, because if we switch to a daily chart, it's tricky to label this entire area here. Yeah, it's really tricky because yeah, is this here 1, 2, 3, 4 and a truncated fifth wave, or is this here 1, 2, 3, 4, 5 in some way, and then this A, B, C in some way or so? Is the correction finished here officially, and that's already next wave 1, 2, or is the correction finished here and this is the next wave 1, 2? Or yeah, I mean, those are pretty much the options. So there's still too many options on the chart, and labeling this corrective mess here, just like I'm not even gonna try. I tried once or twice, but I can't make sense of it. So that complicates the bigger scale labeling a bit, but as long as the lower scale labeling actually makes sense, I really don't care that much, because the overall outlook is still upwards. Yeah, and yeah, so that's about GameStop. Now we can look at Barnes & Noble Education for now, where we are actually expecting to finish the correction here at the 61.8 retracement. Unfortunately, zooming in further than the 12-hour chart already brings like useless candles on the chart, so which doesn't help very much. But if we're expecting that we have a corrective move right now. I mean, unless I'm wrong somewhere, which again happens sometime, then we would expect that this here might be A, B, and C for the third wave down. So we would expect to potentially hit the 78.6 retracement level here. I actually have to open my prediction chart so I can keep track of what we have lately on the chart. But other than that, this should also be ideally, that should be wave 1, wave 2, and we're now slowly developing the third wave. The other option would be that this is 3 waves, this is 3 waves, and now we're getting another 3 waves further down. on the, so let's zoom out again to the 12-hour chart. So on the bigger scale, so we would then be three waves, and then another three waves, which, where would that take us? Would be, would take us here in that area around $8, anywhere between here and here, so $8, potentially maybe even further. I would not really like that because that pattern so far follows quite a few guidelines and usual occurrences, let's call it that. So because we have this retracement here is a visual clear three-wave move. It retraces 61.8%, which is one of the usual retracement areas. It also retraces into the area here, which is the wave 4 of the previous 1, 2, 3, 4, 5 move. And with that, it just follows so many rules that point towards this here being the end of the correction. And from here, we should get the next impulsive wave up that I hate to see, or that I would hate to see me proven wrong here. My investment in BNet is not that big. We have an astonishing 35 shares for $350. So it's really not the end of the world if I'm wrong here. But the pattern is just so nice and clear that I would, from the perspective of Elliott Wave Theory, really hate to be wrong here. Our prediction here, or my prediction here is, by the way, that we go to 1419 or 1977. We already, and that would be kind of like the minimum predictions that we have on the assumption that this overall will be a big corrective pattern before we go further down. If we actually finish the corrective patterns here, and this is the next wave 1, 2 of some kind, then our upside patterns would be much, much bigger, or predictions would be much, much bigger, but the defensive prediction would be based on this. Although I have to admit, to the naked eye, obviously this here is some move that makes one wonder, or should have sold here or something like that. But yeah, our investment is not that big. Our pattern is still valid, and we can see we don't have a huge exposure. And even with our $350 invested, we're currently only $11 in the red here. So no point in closing for a small loss. You can go for a big loss instead. And now, obviously, just kidding. But yeah, either we are proven wrong, but then even so, the investment is so small, we would only close out if we break the $6 mark here, because then all the patterns here suddenly become invalid. I would start to worry if we break the 831. I mean, I would start to worry if we break the low that we had here at around, what is it, 880, because then the assumption that this is 1, 2, and 3 is wrong. I would worry a little bit more if we break the low here at 831, but then we still have the option that this will be three waves, and three waves, so somewhere here-ish in the area. And even then, we can see even up till the point where we would close the position, we have $150 risk. So it's not the end of the world if that turns out to be wrong. It would be nicer if we are right completely, because then we would expect upwards movement in the next couple of weeks and months, and the position gets more and more green. But even if we're not, it just means we have to wait longer before either being proven right and just too early, or being proven wrong and book a small loss that's basically less than, maybe a 1% loss for the portfolio. So, so much about that. We're actually circling back to GameStop right now for a second. We're going to set an alert here at 28.79. So 28.79. So that would then be basically for this 1, 2, 3, 4, 5. So the alternative labeling that I mentioned, just so we don't miss it if it happens during the stream. And with that, before we look into other stuff, I actually want to check something. So ever since I switched to Interactive Broker in May this year, which was a godsend move, to be honest. I mean, Interactive Broker is, like, on one hand, obviously way, way more complex than eToro as like the hobbyist brokerage out there for beginners and whatnot, but also offers way, way more possibilities. And yesterday I read about and learned something about so-called, box spread, or which basically, and I want to check that. So if I pick, we don't need weekly expirations. We need, for example, let's say December next year. December 25. If I do the following, I might do it wrong the first time because, yeah, like anyway, just watch, and maybe you already know that stuff, maybe you don't. So if I sell the 6,000 call and I buy the 6,000 put, they obviously even each other out and would, I don't know, they don't even each other out. They just give me like really, that would give me really like a line in risk if I'm not mistaken. Yeah, so like this. But if I then go and say, I do the opposite thing here, what happens is, yeah, that's what happens. So we have then a solid line. You can see that I have a guaranteed $417 loss. So, which obviously is like, why would you do that? Yeah. But I get, what's that? I get $1,980 paid. Yeah. So for, basically for $2,500, or actually, how do I explain that? It's kind of like taking a loan. So with the result is like the option basically would be for $2,500. So 6,625. So difference is 25 times 100 shares. So it's $2,500. But while I would take a $2,500 loan, I only get $1,980 paid right now, for example. Yeah, $1,980. That means for a year, I pay $520. So in this case, obviously, that's not a great deal, because it would be for a year, it would be 20% technically interest, yeah, on that loan amount. Yeah, but and the loan would only be due at the end once the option expires. So only on the 18th of December, when the options expires, this loan would be due. Now, obviously, I could try to manually, instead of setting the order like this, I could try to pick the mid price here, for example. So if we pick mid, you can see I actually would get 2,000. So let's do that again. So for a $2,500 loan that pays me $2,395, I would, as a result, have to pay $105, which means it would be 10% would be 250. So yeah, 4.2% interest for borrowing $2,500 that I get as credit onto my account, and which I should be then able to use for other positions. Yeah. Yeah, which actually wouldn't be that bad. Now we're going to try to cut that down further. If I can get that for, let's say, we're actually going to try that. So let's see if I can get somebody to buy the whole, if I'm actually able to execute that on my account. So as we see, if we look at this, the profile right now would look like that. It still says 400 because it considers the prices from here. Yeah. But technically, if I get this to execute for that price, which likely will not happen, but that's a starting point, I would be able to borrow, as said, $2,450 or $2,500 total minus $50. That basically is the interest that I have to pay for the whole period. Now let's see if I can submit that on my account. Yeah, it seems to. It has zero impact on my margin from the looks of it. So we'll transmit that, and then obviously we likely will not get this order filled for that price. We're gonna let it sit a little, and then we're gonna adjust it. So I'm willing to, in this case, I'm willing to pay up to $100, which would be as said. So 100 divided 100 divided by 2,500, so which would be like 4% interest for borrowing 2,400 or 2,500 total for a year. Yeah, and if that works. So if that works, that's the one question. So if it can be executed in my account, the question would be, I could do the following. So again, I mean, please, you know, like don't do this at home. Yeah, the actions in this movie are performed by professional stuntmen, and so on. Yeah, like parents, hide your kids, blah blah blah. But if I do the following, yeah. So if we take SPX, so this only works with European style options, which means they cannot be early exercised, otherwise you have a risk. But if I do the following, so sell call, buy call, buy put, sell call, or they actually switch to put. No, that one should be switched to call. That one should be switched to put, or vice versa. So no, the other way around. So switch to call, switch to put, switch to call, switch to put. Okay, so if I would do the following, yeah, so let's say we move this here to the 7,000 area, and we move the expiration maybe to 27. So that's basically 25, 20, so it's 3 years from now. Then I would get 86,460 credit according to OptionStrat right now, yeah, which means for borrowing 100,000 for 3 years, I would pay 14,000 in fixed interest. So the graph looks like this, that as you can see, no matter what happens, I have the 13,500 in fixed loss on the trade, but I get potentially, I said, 86,000 in credit, which I can then, now watch me be a degenerate, yeah, which I can then, if we have 86,500, for example, divided by 25, so and divided by 100, so it's 34. So I could then go to GameStop and say for next Friday, I'm gonna sell, remove that, $25 puts. How many did we say? 34. So which means until next week alone, oh no, that should be switched to, wait, let's remove that. Sell the put, yeah, which is a cash secured put, and we sell for it's minus 34, of course, yeah, so minus 34 because we're selling them, yeah. So for next Friday alone, I would be able to potentially get $3,400 in credit. Again, until 2027, I would need to recover at least the 14,000, which again, if we consider that, so it's not a yearly rate now, but if we consider 13,000, blah, 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 divided by 100,000, yeah, so it's 13.4% interest for the entire 3 years. So again, it comes down to roughly 4% per year. But even in a week, I could sell those puts, pocket in a week, or not in a week, but in what is that? Today we have the 13th. So in 9 days, I could pocket $3,000 in premium, or 3.5, which I could actually use if I wanted to sell another $25 put. And obviously the risk is if GameStop goes broke, then my loss increases. And however, I don't expect GameStop to fall. So the worst case scenario I can imagine is temporarily that it falls to 15, but that's a temporary scenario where then obviously the overall loss temporary would be at 30,000. But even if GameStop would be at 15 and our call and our put was at 25, so we have a $10 difference, that would be the same as if we are at the current price here, and the current price here is 27. So let's say I sell a $37 put. No, so sorry, not put in that case. But so if I get the shares assigned at 25, GameStop falls to 15. And then instead of that, I sell covered calls, $10 difference. So again, we get assigned at 25 and it falls to 15, which is the same thing as we are at 27 and I have to write calls at 37. So, and then we can see that even right now, I mean, I know right now the volatility is higher, which still causes more credit. But right now, if I would have already the shares assigned and I have to sell calls that are $10 higher strike price, it would still pay $4,000 in premium. But again, that's for 11 or for 9 days, which means that technically within, I don't know, let's say, so if that would be the actual number and if it's possible and whatnot, yeah, so the trade actually executes in my account within, let's say 3 trades like this per week. So within, I don't know, 2 months, 3 months, worst case 4 months, the premium from either selling puts consistently or from then writing covered calls should cover the interest that I'm paying on that money. And again, that interest is for the entire time. And after that, you actually look at profit, yeah? Yeah, Olga, that's how many people make/made money until it breaks, yeah? I mean, to be fair, the only breaking point here, and I'm not saying that it's like a good thing, but if we switch this here to a put, then again, we say we sell cash secured puts at 25. The only breaking point here is if GameStop, so I sell the 25 put, GameStop falls below 25 by the 22nd. I get the shares assigned, which means I have a break-even price at 24 in this case, yeah. And then GameStop falls to 0, yeah. Then basically it would mean losing 100,000 because then I have to pay back the full 100,000, but my shares that I got assigned are all worthless, yeah. I don't consider the possibility for GameStop to go to 0 in the next couple of years because even if they're doing that, they are debt-free and have 4 billion in cash. So the other alternative is, okay, it falls lower. I think based on the money that they're holding and the shares in circulation, the worst value would be at $10. That's really would be the worst value. Then it would ignore any kind of like brand value and whatever. And so then it would be basically obviously a $50,000 temporary loss. I mean, you still have the shares, but they would be worth 50,000 less. But then it's also 50,000 to pay back in 3 years. And over those 3 years, you could still sell covered calls every week, yeah. Even though the premium would be little, but you would also, instead of being able to sell like now 5 covered calls, you would be able to sell, I would be able to sell 40 covered calls. So basically 8 times the premium every week. And even if the premium is only a couple $100, if you do that every week, so again, because we're then selling 40 calls per week, then yeah, so even if you only get $5, I don't know, $5 would be really already very defensive, yeah. But so 5 times 40, so you make 200 per week times 52, so you make 10,000 in a year in premium. So then in 3 years, okay, then it still wouldn't work out. But for that, GameStop would need to drop to 10 and stay at 10 with little volatility for 3 years. So yeah, like. I get that doing something like that. So if I were to do this with other stocks or so, I'm not sure if it would be a sane idea. But I think that with GameStop, it's basically using leverage. And if the in quotes core, not advantage would be, but considering my current portfolio size, if I do this to in quotes borrow. Yeah, so if I do this to in quotes borrow, I'm not going to say that I go for 100,000 here. It's just an easy example, yeah. But if I were to do this for 100,000, then basically my current portfolio value would cover the exact cost of the difference. That would be assuming not losing any of the money, yeah. And so even if then nothing changes, then basically I would have just ensured that in 3 years from now, the 14,000 something that I have in my account get just wiped out, yeah, because that's the cost of that trade. But on the other hand, the first time I sell the put option, the cash secured put, I already reduce how much the cost for or I already in quotes reduce my risk, yeah. And even if it goes south, like honestly, so I'm not saying that this is a super sane move that others should replicate. Definitely not, yeah. So that's something that requires thought, it requires financial security, it requires the knowledge that even if this somehow goes completely bad, that within 3 years, so when the option is due, you're capable of coming up with the money, already you have it, yeah. So I'm not saying this is a move that anyone should easily, instantly replicate. Yeah, we're gonna see. As I said, we're gonna make the play here for the 2,500. So I'm willing to lose up to or pay $100 in fee to just see how it executes, how it affects the margin, and so on. Yeah, we're gonna slowly work our way downwards in that case. So, like for example, I'm not willing to execute for that price, which would mean, yeah, especially not for 15, but which would mean we're paying $200. Or $270 in premium, but we can slowly work our way down to see how this plays out and if we get it to execute or not. But yeah, so circling back, while you are 100% right that like until it breaks, yeah, but what is like your worst case assumption for GameStop? Like honestly, like, I mean, of course, it could also be that if I would do this right now and I do this for this price and whatnot, so I get as said, 86,000 in credit, and I can sell 34 cash secured puts. And I think the worst case scenario would be that in a day, GameStop shoots to the moon in quotes, which means, or next week, GameStop shoots to the moon, which means for the week after that, I wouldn't have any reasonable strike price where I could sell the puts. Because I'm not going to sell $100 cash secured put or so, where then if GameStop then after that retraces sharply, suddenly sit there with next to no shares. Yeah, so like you say, worst case staying at 15, yeah? But do you think it can stay at 15 for 3 years? Like really for 3 years? And even if it stays at 15, then we're looking at a low implied volatility, yeah, which affects the premium that we earn. Which it doesn't do here, yeah. But then it just means we earn less premium. And if I get them assigned at 25, then that would kind of be the equivalent. I'm actually going to open a new window for the same situation. But let's say we are selling the calls. So we got them assigned at 25. GameStop falls to 15, which would be $10 difference, which would be the same as if we go here to 37. And if we assume lower volatility, then let's say it would be the same as if we go to around 47. So, and we see that even with a $20 gap with the current volatility, we still would pocket with 34 covered calls, we still would pocket 2,600 per month, while ensuring that our strike price that we sold the covered calls at is the same we got the shares assigned at. So to make sure that if then there is a rally, that we don't suddenly sell them cheaper than we got them assigned. And then if we consider that premium, or we can go even higher if we go here to 50, I mean, it doesn't go higher here, but you see it's still 2,000, that's times 52, which basically would mean up to 100,000 in premium in a year. Yeah, and we have 3 years to make the money back. So of course, in theory, GameStop could go in quotes broke, yeah, in theory, so below 15 or maybe at 10 or so, yeah, and low volatility, but even But even if it goes to 10 or so, we still earn a premium every week by selling the $25 covered call then, even though that premium might then only be 1,000 per week, which still would be, or yeah, maybe it's 500 per week. So it's then still 26,000 in a year. So in 3 years, it's still 70,000, which the shares would still have a value. So we get 3,400 shares. So 3,400 times 10, plus we would still make 26,000 per year. So 60 and 78. So not 70, yeah, minus 78 plus 78,000 actually. So even then we would look at a 12,000 profit guesstimated over the 3-year period. So even if it falls to 10, we sell the $25 calls every week for the next 3 years. The end result would still be theoretically 112,000 in total. That's with no move, yeah. Worst case, staying at 15 just because the market makers can. Unlikely, but that's the cash value after 3 years. Plus, not to mention, I mean, once I get the shares assigned, it's a different equation. But as long as I don't have the shares assigned, I actually have an $80,000 credit on my account on which Interactive Broker pays me interest. Yeah, which also, I mean, the interest is obviously lower than what I have to pay. So I pay 4% for the options play, but I still get some interest, which actually, as long as the puts don't get assigned, yeah, which actually works then in quotes to reduce the debt as well. If I get the shares assigned, I could still be opt-in the stock lending program and also earn a small interest on that. Yeah, but there it's like harder to estimate. But yeah, so unlikely, but the cash value after 3 years or so, doing nothing, no growth, no acquisition, same capex. I think my total is like 1,200 shares or so. I'm looking to exit some after another run. I'd love dividends, enter the S&P 500 and just compound. Yeah, yeah. Obviously, at some point, at least a partial exit would be nice. Yeah, it varies depending on how much you have in your account. Yeah, so EBKR, interest, and then obviously it would also. So you see, for 0 to 10,000 you get nothing, and then for 25,000 upwards you get basically, depending on your overall value or so, yeah, So in this case, we would be looking maybe at this interest rate here, so anywhere from 1.6 to 3.2%. But if executing the options to borrow that money costs 4% per year, and I get 1.6 from Interactive Broker, as long as the puts are not assigned, it would reduce how much I actually pay for this whole move. Yeah, excluding Ireland taxes. Okay, yeah, didn't see that. Yeah, but I don't know. So I think like I'm playing with the idea, obviously, or potentially not with the full 100,000, because that's yeah, like yeah, not really a scary amount, but it's something that over 3 years it's still not too easy to gamble with, in quotes, or it's not gambling, but you know, trade with. But I know that there are some people on oh, that I didn't consider. Thanks for pointing that out. Yeah. But even if they don't exclude me, then I should be able to get it back with the yearly tax declaration or so. I mean, right now it's not an issue, but since right now we don't have cash in the account, we just have positions and shares, yeah. So, or options and shares, or sold options, so actually option obligations and shares. But that's good to know, yeah. One question that maybe you already know, what I wonder about is, if I were to do that, and let's say again, just because it's easier to calculate, let's say we do this for that play for 100,000, yeah, then I get, and now let's assume it's also there is no fee, so it's not that I get 86,000, sorry, but let's assume I actually get the full 100,000 in credit, which obviously is not possible, but just theoretically. Then I would get that credit right now. How would that affect my tax declaration for 24? So if I do the taxes for 24, would then that count as I made 100,000 profit, or would that actually only be considered once the trade closes in the tax declaration for 27? That's the one aspect that I'm wondering about. Yeah. So because obviously, if that would be considered tax-wise already, that it's then considered for this year, then it would be a dumb play to do it right now, but then it would make sense to do it in January. I mean, obviously, how GameStop moves in that case also plays a role here, because if there's some volatility, the premiums are higher, so waiting till January might mean missing out on the opportunity to actually do this profitable. But that's the one thing that I haven't looked up yet. So if the option trades are then taxed at the end, which means it would then at the end actually cause a $15,000 profit in my $15,000 loss in my taxes for 27, which also wouldn't be bad because you can carry the losses forward or it would count against other profits that I make in that year, so not too bad. If, however, it's already considered like a profit now and then a $100,000 loss in 27, then it's a whole different equation, because then suddenly it would be 25% taxes on $86,000. That are then due somewhere in the end of next year. And however, then for 28, I would then have a loss cushion. Yeah, so I'm curious. So it's really, I think the play, again, of course it can go wrong. And if it would be any other stock, I would not consider it, to be honest. Yeah. Or at least I would only consider it to say, okay, like right now, let's say, okay, if I can get 2,500, that's something I have no problem covering, yeah, and I can use it to sell another cash secured put for GameStop, for example, and earn more premium. But if it were for like other stocks or so, I definitely would not want to do this. Let's actually go to, we are willing to pay $100. So let's go at this and see if we can get it to execute. Yeah, that's actually anyway what I would be willing to pay for the small, in quotes, loan, just to see how it works. And yeah, but as that, I'm curious if you know how it would work for tax-wise, the whole play, because I think the play itself, I know it's nothing new. It's just I yesterday extensively read about it, and before that never considered something like that. So my knowledge or thought process ended by, if I sell cash secured puts, I get premium. If I sell covered calls, I get premium. I never considered that I can on purpose make an option trade that has a fixed loss, but actually pays me. Whereas, however, one thing to mention here is the following, not sure if we get to see it, this nice curve. There is actually a situation where if the market moves fast enough early, you can close this with a profit. Yeah. So, I mean, that requires that you still have the funds available and not tied up in other positions. But while at expiration, it's a straight line, up until expiration, it actually has a curve in it that if you close it early at a certain point. So I'm not sure if we switch that. Let's switch this, yeah. And let's say 6,000 to 7,000. Then in this way, it's actually vice versa. We would have net debit, so switching like this, not an option. So, but if we move it to higher strike prices, so maybe 7,000 to 8,000, then there is a situation where, for example, where we are right now, at 6,300 roughly, yeah. So where if the markets drop, you could actually close this early for a small profit. Yeah, that's what I'm afraid of, but I'm not sure. So okay, like one thing to consider here is that for starting from the first of 2021, you can only deduct losses in the height of 10,000 euro per year from options. And however, that was increased to 20,000 euro. Although I think they have plans to actually remove that limitation. Okay, so bei Short-Positionen ist der Verkauf einer Option ist bereits bei Eröffnung steuerrelevant, ja. Yeah, so actually this means that the premium that you get is tax relevant at the time you get it. And when you buy, then you have basically that at the time you close it. So when you buy options, which actually would show in, yeah, which actually means that net credit here would be already tax relevant, which means doing this for a bigger amount only would make sense in the beginning of in the beginning of 24. Otherwise, it would suddenly mean that for beginning of 25, because otherwise it would mean for 24, I would have to declare an $87,000 profit that actually doesn't exist. Yeah. I think tax has to be booked. Yeah. So premium for 24. I don't see a link. So, but if you cannot share it here, you can share it on Discord. For correct tax declaration of options, she also has a way to fix IBCAR's reporting of false statements. It makes absolute sense, but when you sell the option, post this gain after you close her, so that's the problem with IBCAR. Okay. I mean, I have to look into that with my Steuerberater, so accountant or tax consultant or CPA, actually, CPA, once we do the taxes for 24. So, but point being, so depending on the strike prices you pick, I'm not sure if we can move that curve higher so that it actually is. Yeah, so you cannot, that's actually an interesting constellation. I'm not saying that it's like perfect, but where obviously, I mean, yeah, it's not that good either. Yeah. So the other one was actually better. If we go here into the lower areas, how does that affect the whole thing? That's an interesting bet. Net credit $260,000 and max loss 180. But it basically, yeah, would be a bet that markets stay higher. Yeah, I'm not willing to make that bet. Okay, it looks like you cannot get that bump higher than where the markets are currently. Maybe there is a constellation where it's possible, but I just cannot find it right now. So you can see, but basically, if one were to assume that the markets are going to crash, or at least decline, and retrace, then making that play also has a chance that if then within the next couple of weeks there is although that's an insane retracement, of course, we're talking here about a 50% drop, but on the other hand, even a slight drop would allow one to close the trade as a profit instead of closing it as slight, let's say a 10% drop in markets would mean one could walk away with a 1 or 2% profit instead of having in the end to pay a 13% fee. Tricky to judge if it's not worth it, but probably not worth it to close it early, even if one could close it at a profit, because at the end of the day, one would make that play in order to actually borrow cash for other endeavors. So, but yeah, it's like the tax aspect is quite important because one has to consider if there's still the limit of only being able to declare 20,000 at a loss, because if I'd do that and I would get, let's say, 85,000, so then I would have to pay 25% tax on that for 24, which would be 20,000 in tax. But then on the other hand, then when the trade closes, I'm actually paying back 100,000, but I'd only be allowed to consider 20,000 of those as a loss. So it wouldn't balance out fully. So one option would actually be, if you do this with a shorter period. Okay, you say that limit is officially gone. I heard about that, but I wasn't sure about that. But one option would be to actually, the right way to do this would then be in the beginning of 25. So in January, just do this with the December 25 options, so that you basically have the trade close within the year. Obviously, then borrowing 100,000 is then a different play, because then you would have to make the 15,000 in interest plus whatever profit you would like to have in that year. But for a smaller amount, if it's then 4% interest for the year effect, okay, then it would not be 15,000, because then if we consider this sell, buy, and then so 6,000 and 7,000 buy, sell, and I did that now, so it would actually be 5,000 for borrowing 100,000 for a year. So it would be 95,000 credit. I think that's not that bad. So if one does that, so not today, but if in the beginning of January, using that, I'm not saying for the full 100,000, but in general, which also means for right now that play would still possible, but only for the end of the year. So it would be for the December 19th options, or one goes for the weeklies, but there might be less volume. So December 31st options. Let's get rid of this one here. Quite educational today. So let's say for, I don't know, 10,000, so that would be 100-point difference. So buy, sell, and then 66,100, sell, buy. Did I get that right now? I got it exactly wrong. So sell, buy, sell. Okay, now, that's actually not that bad. It's like $70 for borrowing 10,000. No, is it 10,000? No, it's like, God. What do we have difference? 100 points times 100. So 10,000. 10. Of course, 10,000. So borrowing 10,000 till the end of the year for $70 is not a bad thing. So that would be 70 divided by 10,000, so it would be 0.7% interest, although for a month, so, or basically for 1.5 months. So I don't know. Yeah, we'll think about that. Maybe I'll do that. Obviously not with an insane fortune or so, but this way, both of the transactions, the opening and getting the credit and the closing in the end of December, both fall in the current tax year. So it evens out, and you don't have the credit that you have to pay taxes on this year and then the loss that you have to book next year. Yeah, so I know, but yeah, circling back, so obviously don't do this at home, do your own research and so on, but circling back, if we consider specifically GameStop, the thing is like getting the money like this, we know exactly how much the money costs, just like we would get if you would get a loan from your bank or so, yeah, where it tells you, okay, that's your with the difference with the bank, you have a monthly installment, and here you just have to have everything in the end. It might mean that your margin requirement adjusts over time, or that just at the last day you suddenly have to have the money. Yeah, if the margin requirements adjust over time, then it would be the same as paying back the monthly installments, because it would mean you have to have a certain balance over time that is more and more and closer to what you owe. But then if we then consider GameStop specifically, the worst case scenario that I can imagine would be really also the $15 area. In which case, obviously, if we go with selling the $25 put, we look at a loss, but one could also go smaller. One could say, okay, I'm selling the $20 put, which is obviously not as profitable. Okay, there is the net credit is like really, really poor right now. Yeah. So maybe somewhere in between. So getting $800 for 9 days. So even if you do that, so let's say, I don't know. So it's hard to judge because the volatility changes over time, and with that, or the implied volatility, and with that, the premiums also change. But yeah. So worst case scenario, I think GameStop goes to 15. Really worst case scenario, it goes down to 10. But then if you get assigned at 25, you still have the your shares are still worth 34,000, and every week you can still pocket some premium from writing the covered calls. And even if you so even if here we pick the highest possible premium, or one could go even further. So if we think about borrowing till that might actually be also a play. So I mean, I know there's no free money on the market, so yeah, but if we execute this, so again, premiums obviously change and whatnot, but we would get $86,000 and would have to pay back 100. So we have $14,000 in costs. Yeah. If we then, instead of, I'm just going to check, instead of selling the $34 put, if we were just to buy 86,000 divided by $27, so we'd get almost 3,200 shares. So that means 32 op call options. And if we then, for January 20, so we have 32. If we then, for January 27, and here we also have 27, yeah? So if we then, for January 27, sell the $50 call, then we actually right now would get $35,000 credit. But we only have to, we still would have the risk that the shares drop in value, yeah? So that would be the risk there. So basically, if the shares drop in value, so we would also have to add here, can I somehow in this dialog here add the shares? No, remove, exclude, change expiration, buy to close, position. Yeah, so would have to switch this to covered call. December 50, and we said we can sell 32 of those. And that would also mean that we have to assume that we say we have buy to order, so we have 3,200 shares that we got at the current price. Yeah. So then the graph of this would look like that. 32 share. So yeah. So basically would look like this. No. Yeah. So what do you think of that? So again, so we would make this trade. Again, it doesn't matter if it's 100,000 or 10,000 or 5,000. Yeah, it just then the numbers scale the same, we would get $86,000. $86,000 get us 3,185 shares. So technically we would have then 3,200 shares, which means that credit expires in December 27. And we can then basically, the longest option for GameStop would be January 27, which means we could sell the $50 call, which gets us $35,000 in credit. However, our cost for the loan is only $14,000. So we have already $21,000 profit in credit. And it then basically, as long as GameStop stays above 14,000. So as long as GameStop stays above 20, we actually guaranteed a break even or have a profit. Yeah. If GameStop actually rallies and in 27 would be above $50, we would actually make 100,000 profit. And the risk would be, as said, that GameStop, I cannot adjust the negative. Oh no, there anyway. So the risk would be that GameStop loses in value. If it goes down to $10, we would look at $17,000 loss plus the fee for the credit. So it would be $30,000 risk by borrow. So we would borrow 100. So assuming that GameStop cannot go below $10. Yeah, that's obviously the one assumption here. Yeah, but if GameStop goes to $15, that option play would actually mean that our shares lost as much in value as we got in premium. Now the question would be, at what point would we theoretically get there? April 25. So while we would borrow money till December 27 for $14,000, and in this case, if we directly buy the shares instead of trying to generate premium through cash secured puts, and then directly sell a covered call for April 17 next year, then we already would get 14,000 in credit, which means that one trade, assuming that the shares don't decline in value, yeah, would already cover the cost of the loan. And then after April, we could then oh no, actually even shorter. If we buy them at $26, then even selling the option for December. So if we buy them at the current rate, at 26 something, then even the option for writing $27 calls with expiration in December would already pay us the premium, 15,000. And if it closes above 27 or the options get executed, we get the shares called away and have the full 100,000, which means that trade alone would already cover the fee of the whole loan. Yeah. And then we could sell cash secured puts or do something else with the money, or just actually then you could just have the 100,000 sit and earn the interest. So, I mean, again, that's assuming that then GameStop actually in December is above 27 and the shares get called away. But if not, you just sell the next covered call. So I'm not saying that it's riskless, because again, there is no such thing as free money. But I think there are some interesting constellations, specifically in that case with GameStop, with the strong belief or opinion that it might go down to $15, and I don't see it going lower than that ever. But let's say even it goes down to $10, you still have shares that have a value. You still have time to write covered calls against those shares for up to 3 years. Again, assuming that you can find the liquidity to execute this trade here. But yeah, like Olga, I would really be interested to hear your opinion in basically, again, maybe not 100,000, maybe 10,000, and then instead of 34 options, it's then only 3, and instead of getting 100,000 loan, it's 10,000, and instead of 86,000, it's only 8,600 in credit. Yeah, and then maybe instead of selling the put options, directly selling the covered calls, either very short term with a closer strike price to already cover the fee for the loan, or highest strike price possible, but for that then it has then to be a little bit further out to cover the loan. Yeah, but then let's divide it down. So instead of 100,000, let's make this, we have 3 options, and here it's also, instead of that, it's also 3, and instead of that, we actually go to make this play like this. Voila. So we get 8,855 for a cost of 1,145 for 3 years. Yeah. So that's like a smaller amount. Yeah. And then for 8,855, sorry, divided by 27, we get 327 shares. Yeah. So which means, and again, we have 1,145 costs, which means we can sell 3 covered calls where we either can, I'm going to duplicate that so we can visualize both scenarios, where we either can say, okay, for the 20th of September, we sell the 27 strike price covered call, which gives us 1,400 credit. Or for the 17th of April, we sell the $15 covered call, which also gives us 1,400 credit. Yeah. So while it's not a lot in that case, but that means that first trade that either already ends in December or ends in April would already cover the cost of 1,200 that we have here. So we already recouped what we will have to pay in 3 years. Again, that's now ignoring the tax situation that we would have to declare this as a profit from options trading this year and so on. Yeah. So it's ignoring the tax factor. But after that, if we go with that variant, I think with the current movement, there would be a decent chance to have the shares called away, which means we just pocket that and have the full 10,000 in the account. Again, it's borrowed money. And obviously, if we would lose it with trading, it would be bad. But we could then let the 10,000, okay, on 10,000, we don't get interest on Interactive Broker. But if we would have 10,000 of our own cash already sitting there, then those 10,000 would actually earn 2% interest or so for the next 3 years. And that interest would be pure profit on borrowed money. Yeah, but there's no tax benefit on options trading as far as I know. So with the GmbH, you only have the tax benefit on the profits from selling shares. So, but the limited liability would obviously be tempting. Yeah, that's another aspect there. Yeah, but if we, I don't know, I really think in the current situation. So, of course, buying the shares right now, especially when I expect that we will get a decline potentially down to 23, is not the smartest move. Yeah, but yeah, I know we had the discussion already. I'm just repeating that. Maybe I misremember, but so as far as I recall, we have, so you have around 2% tax on profits that you make from selling, holding, so buying, holding, and then selling shares. But if it's options, you still have the full 25. And then when you want to take out the profits to actually benefit from it personally, you would still have the full income tax on it. Yeah, but. And again, so like considering the current situation where I expect the move down to 23, it would not be the smartest move to say, yeah, I'm going to buy the shares here at 27 to make that play. But overall, just considering the premiums, it seems like, okay, you borrow the money, in that case, 10,000, not 100,000, which is again manageable because it's not like you don't have to risk the entire amount if you don't want to. The sale of that is taxed as shares. Sorry, so. Yeah, but you have them called away at the same strike price. So if we buy them right now at 27, we would also sell the 27 call. And then when they're called away, you don't have a profit on that. So the only profit you had was from the credit, from the premium that you get. So I understand that if I get shares assigned at 30 and then I sell a $35 call and they get called away, that then the shares, the $5 difference per share is taxed as profit on holding and selling shares. No, that's my point. So on one hand, I could either sell at the same strike price and have then a shorter expiration, so it would only take till the 20th of December, and it would net the 1,400 credit that the whole loan costs. It's actually already a small profit, yeah. Or the other extreme would be I pick the highest strike price, which would be 50, and however, then I would need to pick the April expiration date to then basically lock in. Yeah, something's wrong here with that because we don't have the shares here on the table, but that should be we sell free covered calls. So that profit here should actually be kept at 50. It's probably because, no, there we have the shares now. So, because I didn't update that. Yeah, so we would have 300 shares in that case. Sorry. And then we need to update that here as well. So that changes the equation. So still, yeah. So one thing, short expiration and same strike price, but short expiration. In December, we basically either have the shares called away and we already earned $400. And then we have 10,000 in our account sitting that is borrowed money that we theoretically could earn interest on for 3 years, or higher strike price, the other extreme, so $50 strike price for April, in which case we in April would have the credit and have the fee recovered. Of course, if GameStop drops in value, we lose on the shares, yeah. But then we still have then basically almost 3 years left to sell more covered calls. And if GameStop actually rallies up and we get it called away, we might book a profit. So if GameStop really would go above 50 by April 17th and we get them called away, then we actually look at an $8,000 profit, plus that should consider the premium already, yeah, because here's the 0 point considering the premium. So we look at an $8,000 profit minus what we paid for the loan. So it's then a $7,000 profit till April, theoretically. I mean, that would be if GameStop rallies above 50 by that point. And would have $17,000 sitting there in the account that theoretically could just sit there till December 27 and earn interest. Yeah, so you can always use short expiration at a slightly higher strike. Yeah, I mean, that would be the scenario in between. Yeah, so instead of going, let's triplicate. So instead of going for this or for this, it wouldn't say, let's pick 27th of December and the $32 call. Yeah, so it also, or maybe even a little higher. So that one, $33 call, also covers the fee of the loan. And again, same thing. If GameStop by the 27th of December is above the $33, on top of that, you'd actually not just pocket this, but a $2,000 profit, and the entire amount could then sit till 27 and earn you interest. And if you don't want to risk it, or you just use the profit, the 2,000 that you made to trade further, and you don't touch the 10,000 that you borrowed, yeah, it feels like not the worst move. Like, I mean, the question is obviously for what price you can get it to execute. So we can see, for example, that right now I cannot get that small box here to execute. I would need to be willing to pay 240, which would be 10% interest, or maybe more. So based on the mid price. And yeah, but it might also be that just for those specific strike prices, there is not that much volume or whatever. Yeah. So yeah, don't ask me in quotes. But I like the idea. So obviously it's a way to fuck up your life as well if you do it and borrow cash that you definitely will not be able to repay, and you then gamble with that cash like a maniac. Yeah, then it's a way to basically say, yeah, go big or go broke or go home. Yeah. But on the other hand, if you do it with amounts that you actually could pay back. So for example, one of the issues that we are personally having is because we are self-employed, because we just in 22 moved to Germany, because only since 23 we have our GmbH. We don't have, my only personal income tax statement is from 2017 and 18. So if I would want to get a loan at a bank, it would not be easily possible because the paperwork simply doesn't exist yet, even though our income is not bad. Yeah. But I would be easily able to pay back whatever, like if it's 100,000 in 3 years, okay, that might be challenging, yeah. But if it's like 50,000 for a year, for 3 years, definitely possible, yeah. And so there is an amount where I would feel also, okay, do I want to have the burden and stress? But there are also amounts, if I do that play, where I'm perfectly fine with. Obviously, I would be a little bit annoyed if it goes south and I, in quotes, lose the money trading then, yeah. But there are also amounts where, so like, I mean, I don't expect that my trading decisions long-term are losing me money, yeah. It basically is just amplifying my trades. So instead of making a plus 5% return on my $10,000 or $15,000, it would be on a $50,000, yeah, or 60,000 or so. And instead of losing 5% on $10,000, it would be losing 10% of $60,000 or so, yeah. So yeah, the other question that I'm now actually curious about, not that I plan on doing it but I would like to know it. If you do that, because I read a post, yeah, from a guy that mentioned, I mean, that's just too degenerate. His approach was just shorting a stock so he gets the credit and then exchanging it for euro and withdrawing it. Yeah, I'm not sure if that's possible, but that's definitely retarded level infinite, because then you have to pay the borrowing fee for the shares, and if the stock increases in value, you just suddenly have an infinite risk attached to your loan. Yeah. But the big question would be, if you do that, could you withdraw the money? Yeah. So if you sell that combination here, would you be able to say, okay, from that you now withdraw whatever 2,000 to your personal account? Yeah. Not that it's smart, but it would be a decent alternative to regular loans at the bank. Yeah. Because I'm sure it should be possible to get a better interest here than what you would get at a bank. And you just would have to then say, okay, you also start to monthly move money into a separate account, a Tagesgeldkonto that pays you 3% interest or so. And so that when this loan is due, you can pay it back all at once. Yeah. So, but that would be an alternative then also to basically, in quotes, take a personal loan. Again, it's for sure probably against the terms and whatnot and so on. But the question would be if it's possible. So I only yesterday, when I was looking into the whole box trading thing, I saw one Reddit post that talked about, I said, shorting stock and then converting to euro and withdrawing it. But I'm curious if it would be possible in general. Yeah. So I will play around with this. I know it was a long educational session right now, but I will play around with this to see if I can get this small trade maybe execute, or to do this for like up to, I don't know, like I would say $3,000 or $5,000 for starters, just to so that if it doesn't work the way I wanted to, I lose 100 or 200 in fees. I can live with that. Yeah. And then maybe increase the amount a little, but just to also see, would I be able, or would it be possible to withdraw that, yeah? Or withdraw parts of it? So to really consider the option trade as a kind of personal loan. Yeah? It's like might be useful considering our huge tax bills and so on to use that as a temporary gap. So to have a 4% interest rate loan through options instead of having to pay, I don't know, temporarily pay 8 or 10% for overdrawing the bank account or so. But just wanted to share all of this. I know it's off topic, or actually it's not off topic, but wanted to share all of this today. Now, GameStop didn't move very much right now, but again, I still expect we might see the downward move to 23. Which actually would make this play really, really cool today, because if we get that move down, I could sell the $23 put or $22.50, or maybe to be safe, the $22 put, but then the premium for that put would also be lower. It would be similar to right now selling the $27 put. So we could see that for selling 3 of those puts, it would be $650 in premium, which would already be half of the cost of loaning the money in the first place with basically a 9-day trade. Yeah, and if I would get if we move down here, I sell the $25.50 put, and it actually goes lower and I get assigned, I'm still at a price where I can live with holding those shares, and it would still be, if we talk about 10,000 total, it would still be for an amount that I can handle easily. So yeah, so not, yeah, anyway, so I'm waiting, I'm expecting this move down. I will play around a little bit further there. We'll see if GameStop goes higher here, which would be nice to see, but if it doesn't happen, so be it. I mean, if we first get the move that I expect, so be it. And Barnes & Noble Education, as said, we are waiting to see if now we bounced on the 100% target, so fingers crossed that indeed will be the perfect down turnaround. Yeah, let's see if you have 3,000 shares tomorrow, yeah, or if it says like balance 86,000, yeah, somewhere here, net liquidity. Actually, would then be 90,000, 100,000 actually, since I also have the 14,000 in the portfolio, yeah. But I cannot do that for that big amount because of the tax implications, because it would fuck me next year. So because it would mean I would suddenly have to declare $100,000 or $86,000 profit plus the profit that I anyway already made from trading this year for 24, which means next year I suddenly would get a tax bill of 25,000 or more. So which means I would then be forced to within a year earn that in profit so that I can withdraw it and pay the taxes with it, yeah. Whereas if so I will definitely do this with a smaller amount right now to figure out how it works, and again, like risk losing a couple hundred on fees and whatnot just to see how this all interacts. But for the big $100,000 play, as tempting as it would be, I would only do this in January, because that would then mean it falls into the tax declaration for 2025, and with that, the tax for it would only be due in 26, which means it's basically pretty much 2 years where you can use the money to work for you and earn premiums before you have to pay taxes on it. Yeah. But yeah, so circling back, BNet, it looks like we bounced here. No promises yet, but it could be that this is actually really going to be the next upwards move now. GameStop we covered. The rest of our plays, Novavax going to be the one thing we're waiting. We bounced here almost perfectly. So yeah, missed a little bit the minimum target by a few cents. On the other hand, also almost perfectly reached this minimum target. So possibility for another push a little down before we go further up. But it's also at the 61.8 retracement. So there are also so many things that point towards, while I was wrong here, assuming that this is the end of the correction, but it looks like A, B, C, that might actually be it. However, I could be wrong and we drop another $2 per share, so who knows. But right now I'm hopeful, although for my options in January, it already will be too late, even if we start the upwards move now. Ethereum, let's check that, yeah. So actually, yesterday I sold my storage and XYO holdings and made pending orders for Ethereum on the usual 3 suspect retracement levels on Coinbase. Yeah, so far not much happened, but I would not be surprised if I said this will be, there could be another push, because visually if we look here, we might have 1, 2, 3, 4, and there could be still a push to 5, yeah. But it's also as possible or as likely that this is already the whole 5-wave move, which makes this 1, 2, 3, 4, and 5, and which would mean we are now correcting this entire move, which would mean we would expect to at least go down to the 21.4 retracement, so 3,177. But most likely our usual retracement levels, which would be a set those here. So planning to enter here again. Maybe I'm wrong and it just goes up further, then so be it. I just then earned some interest on the USDC that I converted my storage and XYO into. And I did that because in StoreJ, we also saw that we are beginning a correction. We already reached the minimum thing, but I don't think that's the full correction. And in XYO, we also see that we are beginning a correction that likely might be 3 waves, and another 3 waves. So down here. And yeah, let's see if that pays off. Now, other than that, I think in Amazon, actually prediction sheet, where do I have you? Amazon, there we have much room. So I think 251, as we can see, to 344, unchanged. What else do you want to cover? What's DJT doing? Actually retracing, that's interesting. From the looks of it, this is a 5-wave move. 1, 2, 3, 4, 5. So this should be a corrective move, A, B, C, which means from here we would expect another upwards move. We'll have to wait and see how it plays out. And what does the Nasdaq do? There we have also long predictions, or we keep going up. Yeah, so I mean today we're a little bit in the red, but visually, naked eye, 1, 2, 3, 4, and then we get push 5. Yeah. So although our prediction here is relatively high with 24,000 based on the bigger pattern, so it's more long term. But even short term, while we could retrace further and further here, yeah, I think that independent of the retracement that we get here, that there's still one push due. Yeah, and I think we'll leave it at that for today, actually. So stream is much longer than expected because we went into the box spreads, or however they're called. I think box spreads is the right term for those options. Yeah, we didn't get any new predictions. We'll have to wait and see how certain things play out, blah, blah, blah. I'll be happy to report the progress in quotes of the whole options loan theory gamble thingy. And yeah, Olga, thanks for interacting and for, like bouncing the whole topic back and forth with me. Everyone else, thanks for stopping by. Also nice to see you. Clash of Tunes, been ages. Rai, yeah, thanks for watching. I mean, although it's your job, so still thank you. And yeah, with that, have a great rest of the day. We see each other tomorrow with another episode of Daily Market Mastery around 5 minutes before the market opens. Till then, bye-bye.